Our today's topic is financial leverage or trading on equity. Students, in the previous video we have studied that capital structure is the proportion of debt and equity used for financing business operations. That means the amount or the proportion of debt as well as equity in the capital is called the capital structure. Now students, for understanding this in a better way, there's a concept called financial leverage or trading on equity. Financial leverage or trading on equity is the proportion of debt in the capital structure. What is the proportion of debt only in the capital structure? It says that with the increase in the debt, the market value of the share increases. Students, we all know that the main objective of financial management is to maximize the wealth of shareholders by increasing the market value of shares, by increasing the earnings of the shareholders, right? So this concept of trading on equity or financial leverage says that with the increase of debt in the capital structure, the overall market value of the share increases. How? So this is how we're going to study it. Students, trading on equity raises the earning per share of equity shareholders. Earning per share means EPS. EPS of equity shareholders increases with more use of debt. How? Students, we've already studied that with the use of more debt, the cost of the company is ultimately going to reduce. How? We all know that debt is cheaper as compared to equity. If you just missed it, you can see the previous video on it, which says that debt is cheaper as compared to equity because tax is not to be paid on the interest which is paid on debt, number one, and number two, the rate of return expected by the lenders is less as compared to equity. Therefore, that way also we are saving the cost. As a result, we know that debt is less costly as compared to equity. So if we are having more of debt, that means we are saving our costs, we are saving our money. So in this way, the earning per share of the equity shareholders increase with the use of more debt in the capital structure.
This can be better explained with the help of an example. Let us assume there is a company X which has total funds of rupees 30 lakhs. The interest rate to be paid on debt is 10% per annum. The tax rate to be paid is 30%, and earning before interest and tax EBIT is rupees 4 lakh. Now let us assume there are three situations. Let us assume the company has not taken any debt in situation number 1. In situation number 2, the company has taken debt of rupees 20 lakhs. And situation number 3, the company has taken debt of rupees 10 lakh. Now let us do the EPS EBIT analysis. EBIT is earning before interest and tax, and EPS is earning per share, how much the shareholder is earning per share. Now EBIT in all the three situations were assumed to be 4 lakh rupees. This was already given in the question. Now interest rate was 10% per annum. Now in situation number 1, there was no debt, right? So in case of no debt, no interest would be charged. So the interest is nil. In situation number 2, the rate of interest was 10% and the debt was 10 lakh rupees. So 10% on 10 lakh is 1 lakh. So the interest is 1 lakh. In situation number 3, the debt was taken of rupees 20 lakh and the interest rate was again 10%. So it is 2 lakh, which is the interest rate. Now next is earning before tax. Earning before tax, obviously you will subtract interest from earning before interest and taxes. First of all, we have earnings before charging interest, before charging taxes, which is 4 lakh. Now after subtracting interest, we get earning before tax. So after subtracting interest, we have in situation number 1 4 lakh as earning before tax and 3 lakh in situation number 2 as EBT and 2 lakh in situation number 3 as EBT. Now then comes tax rate. Tax rate was 30%. So 30% of 4 lakh is 1,20,000. 30% of 3 lakh 90,000. 30% of 2 lakh is 60,000. Now we will subtract this tax also to get earning after tax. It is 4 lakh minus 120, it's 2 lakh 80,000. 3 lakh minus 90,000, 2 lakh 10,000, and in situation number 3, 2 lakh minus 60,000, it is 1 lakh 40,000. Students, the total funds of the company were rupees 30 lakhs, right? So, in situation number 1, no fund was raised through debt. Debt was nil. That means all the funds were raised through equity. So we can say that rupees 30 lakh was rupees equity because there are only two sources of finance, debt and equity. When debt is nil, that means all the fund has been raised through equity. Now, how would we calculate the number of shares? See, we know that the face value is rupees 10, and as given here, the face value is rupees 10 and the total funds were rupees 30 lakhs. So 30 lakhs divided rupees 30 lakhs divided by rupees 10 will give you number of shares, which is rupees 3 lakh. Okay, so in situation number 1, the number of shares is rupees 3 lakh. In situation number 2, the company used debt of rupees 10 lakh. That means out of total funds of 30 lakhs, 10 lakh was debt. That means remaining 20 lakh was equity. So 20 lakh divided by 10 gives you the number of shares, 2 lakh in situation number 2. In situation number 3, the total debt raised by the company was rupees 20 lakh, right? Now, out of total 30 lakhs, if 20 lakh was through debt, that means remaining 10 lakh was financed through equity. So the number of shares would be 1 lakh. Now, students, earning per share is earning after tax divided by number of shares. Earning per share, how much the shareholder is earning per share. Now, student, in situation number 1, earning after tax was 2,80,000. 2,80,000 and number of shares were 3 lakhs. So 2,80,000 divided by 3 lakhs is 0.93. In situation number 2, EAT, earning after tax is 2,10,000 and number of shares is 2 lakh, which gives you 1.05 as earning per share. In situation number 3, it was 1,40,000 divided by 1 lakh gives you 1.40 as earning per share. It is clearly seen from all the 3 situations, then with the increase in use of debt, the earning per share of the shareholder is increasing from nil. In situation number 1, when there was no debt, the earning per share was 0.93. When there was debt of rupees 10 lakh, the earning per share was 1.05, and when the debt increased to rupees 20 lakh, the earning per share was 1 lakh 40. Students, earning before interest and taxes, the total earnings of the company, the profit of the company without deducting interest and tax. Okay, so the real profit is always by deducting interest and taxes. So once we deduct the interest, we get earning before tax because we have not deducted tax as of now. Once we deduct tax out of this earning before tax, we get earnings after tax. This earnings after tax is the total distributable earning. Total distributable earning means the earning which can be given to equity shareholders. Okay, although the companies do not give whole amount as dividends to equity shareholders, but still this earning is a distributable earning. This can be given to the equity shareholders. So if you have to find out the earnings of equity shareholder, you can only find out the earnings through earnings after tax. That means the distributable income. So the next is ROI. ROI is return on investment. What return is expected from the investment made by the company? Students, in this case, the investment made by the company was 30 lakh rupees, right? And what is the return they have earned? they have earned return of rupees 4 lakh before interest and tax. EBIT is earnings or the return which is earned by the company before interest and tax. So ROI in this case turns out to be 13.33%, which is calculated by dividing EBIT with total investment into 100. Earning before interest and tax divided by total investment into 100 gives you return on investment, that is 13.33%.
Does EPS always rise with the increase in debt? No. EPS does not always rise with increase in debt. It rises till the time ROI is greater than cost of debt. If cost of debt increases ROI, then in that case EPS is not going to rise.
To understand this in a better way, let us take example of another company, which is Y Limited. In this question, everything remains the same except EBIT here is 2 lakh in all the three situations. In company X, EBIT was 4 lakh in all the three situations. Okay, so here the EPS that the company is earning is decreasing with more use of debt. Now in this question, the interest rate is 10% and debt in situation number 1 is nil, situation number 2 is 10 lakh and situation number 3 is 20 lakh. So it is nil, 1 lakh and 2 lakh as interest. Then EBT is EBIT minus interest. So in situation number 1 it is 2 lakh, situation number 2 1 lakh and situation number 3 nil. Then tax rate is 30%. 30% of EBT, 30% of 2 lakh 60,000, 30% of 1 lakh 30,000 and 30% of nil is nil. EAT is EBT minus tax, which is 1 lakh 40,000 in situation 1, 70,000 in situation 2 and nil in situation 3. Now we all know that number of shares is 3 lakh, 2 lakh and 1 lakh, which is discussed in the previous question. And EPS is EAT upon number of shares, earning after tax upon number of shares. So in situation 1 it is 0.47, situation 2 0.35 and situation 3 nil, which clearly shows that in this particular case of company Y, EPS is reducing from situation 1 0.47 to 0.35 to nil, 0. This is because here in this situation ROI is not greater than cost of debt. ROI is less than cost of debt. Students, cost of debt is 10%. Cost of debt means what interest you are paying to debt holders, debenture holders or the lenders. What interest you are paying them. So rate of interest, or you can say cost of debt, is 10%. But return on investment in this particular case is 6.67%. Rate of interest is 10% while ROI in this case is 6.67%. This has calculated by EBIT upon total investment into 100, which gives you 2 lakh divided by 30 lakh into 100, which is 6.67%. Students, so it clearly shows that in company X, ROI was 13.33% because EBIT was 4 lakh, right? And rate of interest or cost of debt was 10%. Since ROI was greater than cost of debt, EPS was increasing with use of more debt in the capital structure. But in case of company Y, EBIT was 2 lakh rupees, right? As a result, ROI turns out to be 6.67%, which is less than the cost of debt or rate of interest, which is 10%. As a result, with more use of debt, the liability of the company increases, the financial risk of the company increases, and earning per share, instead of increasing, reduces. Students, this happened because of a particular logic. The logic is very simple, that return on investment is the return that the company expects with that particular investment. Okay, so if the return is less and the rate of interest or the liability of the company is more, then obviously the owners of the company would feel that there is more financial risk in investing in the company, right? So if the cost of debt is more, like in company Y, the cost of debt was 10% and the return that the company is getting is only 6.67%, that means the company is under financial risk. There may be the risk that company may not be able to meet its financial liability. As a result, investors hesitate to invest in this company Y, which leads to reducing the earning per share. This is the logical reason behind it.
So it brings us the conclusion that use of more debt increases the EPS when ROI is greater than cost of debt.